Hello my investor Janta, welcome back to our video. So in this video we will talk about price to earning ratio, which is called PE ratio. PE is most looked out ratio by investors, especially retail investors. But most of us have understood it wrongly and considered that PE is decided by price and earning. In this video, we will bust this myth together. So, most of us know that PE is nothing but price to earning ratio, which is calculated by dividing the share price with the earning per share, or it can be calculated by dividing the market capitalization with profit after tax. PE is considered to be indicator of value of a company. Companies trading at a higher PE are considered to be costlier, and companies with the low PE are considered to be cheaper ones. But what does PE represent? For example, share price means how much money one has to forgo or get while buying or selling a share, and earning per share represents how much profit a company is earning each year. Similarly, what does PE represent? One way is that it represents the number of years it will take for a company to pay back the amount equal to share price, provided if the company's earnings remain constant over the coming years. Another view is that PE is the inverse of the interest rate that company earns in the terms of profit on the share price. One more view is that its value represents the market participants' perception towards the company. So, rather than calling it PE ratio, let's call it perception indicator. Let's understand the last view, that is perception indicator, in better way by taking the analogy of a family. Let's say a person has two sons named John and Johnny. John is honest and hardworking. He is very good in studies too. On the contrary, Johnny is not that much good in study, and also he does not put any efforts in extracurricular activities. Further, he is dishonest as well. One day both of them went to his father. They want to start a business individually and want money for that. So, to whom father will be more comfortable to give the money to start business? Of course, to John. It is not hard to guess the reason. It is because John has a good reputation, that his father has a good perception towards John. Let's replace the father-son duo with the friends in our another example. Let's say for now you have two friends. One is John and another is Johnny. Both of them run business. John's business is in IT sector. Presently, his business is at small stage, but it is growing at a good pace and expected to continue the growth momentum in coming years. Whereas Johnny's business is in newspaper industry, his company size is big, but it is showing degrowth for last few years, and this degrowth is expected to continue. However, this year both earned equal profit, but John's company profit is increasing while Johnny's company profit is declining. Further, John is dynamic and always looks for the new business opportunity, whereas Johnny is lethargic and not very enthusiastic to capture new business opportunities. Over and above that, Johnny is dishonest and does have some allegations of fraud in past. Now both of them want to sell their 25% stake in business and offer ownership of their company to you. Let us assume that both of the company has earned equal profit this year, say $10 million. Now, will you pay the same price for the both businesses? Let's say you are ready to pay $50 million for John's company. Will you pay same amount for the Johnny's company? Of course not. You will pay less than what you will pay for the John company. It is not hard to tell like why it is so. Some of the reasons are: first, Johnny is not honest. He has some past allegations as well. reputation of a company run by him will be at risk. Second is like Johnny's company works in a dying industry, so there are no avenue of future growth here, while John is working in one of the booming sector, so higher future profit is expected. Because of these reasons, friends, you don't have good perception of Johnny's company. Therefore, you will pay lower price for that. Whereas John's honesty, capability and his line of business will create good perception about his company. So, one is ready to pay higher price for his business. With same earning, higher price means higher PE. Remember, P is price divided by earning. From just discussed analogy, we can conclude one thing, like perception is not decided by price, but price is determined by perception, and PE ratio is perception indicator. So, it can be concluded that PE ratio is not decided by price, but this is price which is determined by PE. This is quite contrarian to common belief. To emphasize more, let me repeat, friends, perception about a company decides what PE one should pay to buy it, and PE decides what price one need to pay that company. So, PE is controller here, not the price. Now, how this knowledge will help us in our investing journey, and let's discuss that. As perception is controller, so first one should build up his perception by doing industry and business analysis of a company. After that, one should look at price to know whether it is cheap or costly and accordingly take decisions to buy or not. Here we are not talking any strange or new thing. We always follow this when we buy anything, be it fruits or vegetable, it can be mobile or car. First we build the perception according to the qualities or features and then make decision whether we want to buy it or not. Once we want to buy it, then we ask the price and then take final decision to buy or not as per the price appropriateness and our affordability. But while buying shares, we, especially retail investors, do exact opposite. We just look at the price and PE and make opinion that whether it is costly or cheap. If it is low PE, we buy, else do not. Companies with low PE is not always good investment. In fact, if they have low PE consistently, then may means there is bad perception about the company. It is like bad fruits which no one wants to buy. Conversely, company with high PE is not always bad investment bet. It may be like a diamond which everyone wants to buy. From this discussion, it may seem that there will always be better perception about a good company, so they will have always high PE. That means good company will always be costly. It is like a diamond, always be costly as it always considered value. But it is not always true. Market give us enough opportunities to buy these diamonds, that is good company, at lower PE or price. In our next video, we will discuss about the factors which decides the PE. To summarize here, it is perception or PE which should be considered price controller, not the price as a controller of a perception. So, one should build up perception by doing the business and industry analysis and then look at the price to make decision whether to buy a company or not. Hope this video helped. Thanks for watching. If you have learned something new, please share and like this video and subscribe for more such videos.